Hey everyone, and welcome back to The Explainer. Today, we are putting on our equity analyst hats and conducting a really rigorous, unsparing stock valuation. Our subject? Rigetti Computing, ticker symbol RGTI. Now, this is a deep tech company working on quantum computing, and they're carrying a market cap of nearly $5.8 billion. But here is the catch. Valuing a hyper-speculative company like this using standard financial metrics, it's honestly like trying to measure the temperature of the sun with a mercury thermometer. It's going to be a fascinating stress test of traditional finance.
Okay, let's dive into this. Here's our agenda for today. We'll start with the challenge, then walk through absolute valuation, relative valuation, and asset-based valuation. Finally, we'll bring it all together for the final verdict.
Section 1. The challenge, man versus math.
So valuing mature companies is usually pretty straightforward, right? You look at their steady cash flows and just project them out. But Rigetti is an entirely different beast. Now, what's really interesting about this slide is this single staggering number, negative 2,634.04%. That is Rigetti's trailing 12 months net profit margin. Literally, for every single dollar of revenue they bring in, they are burning through exponentially more. Right away, this hooks us and establishes just how insanely difficult this valuation is going to be. I mean, how do you even begin to value a company losing this much money right now?
Well, to do this right, we kind of have to act like financial detectives. The raw data dump we have is purely historical and current metrics. It completely lacks forward projections or listed competitor peers. So to bridge that gap and actually make our models work, we have to rely on sensible default assumptions. For our models, we're going to assume a standard 3% terminal growth rate and a 10% discount rate to account for the incredibly high risk here. Without these assumptions, honestly, the math simply stops working.
Moving right along to Section 2. Absolute valuation, the impossible DCF.
Okay, so in absolute valuation, we try to find the intrinsic, standalone value of a business based purely on the cash it can generate for its owners. Just as a quick refresher, the discounted cash flow, or DCF model, is basically the gold standard of investing. It involves projecting the free cash flows out into the future and then discounting them back to today's present value, using that assumed 10% discount rate we just talked about. The logic is simple enough. A company is worth the sum of all the cash it will ever produce.
But applying the DCF to Rigetti gives us a really harsh reality check. Their trailing 12 months free cash flow is negative $77.2 million, and their total revenue over that same exact period, only $7.08 million. If we try to project a negative $77 million cash flow forward, our present value becomes deeply mathematically negative. The intrinsic value is utterly undefined here, unless we inject highly speculative assumptions of explosive future profitability, which, let's be real, standard metrics just don't support.
So, if the DCF fails us entirely, what about the dividend discount model, or DDM? Can we find the present value of expected future dividends instead? Maybe they are returning value to shareholders directly.
Well, you can probably guess the reality of applying a dividend model to a pre-profit quantum computing stock. The dividend's compound annual growth rate is exactly 0%. There are absolutely no dividends. Therefore, the intrinsic value according to the DDM is exactly $0.
All right, let's try one more absolute model, the residual income model. This one starts with the current book value of equity and adds the present value of future residual income, which is net income minus an equity charge. It's super useful when the DCF fails. But here again, we hit a wall. Rigetti's net income is negative $116.2 million. Subtracting an equity charge from a massive negative net income just makes the future residual income massively negative. Intrinsic value is totally destroyed here too. To summarize our absolute valuation efforts so far, classic textbook models simply cannot justify the current market price using the historical data we were provided. The intrinsic value is fundamentally undefined, or it's heavily negative. The math is practically screaming at us that the business, exactly as it currently operates today, does not sustain its value.
Which brings us to Section 3, relative valuation, astronomical multiples.
Since we clearly can't value the company based on its own cash, let's see how the market values it compared to assumed peers. Relative valuation is essentially asking, hey, what are people paying for similar houses in this specific neighborhood? Since our source data doesn't actually list specific peers, we have to assume standard tech industry averages.
In a normal growth tech environment, a healthy enterprise value to sales multiple might sit somewhere between 5x and 10x.
So the crucial point is, look at Rigetti's actual reality here. The price-to-earnings ratio is negative 26.12 because, well, earnings are negative. The EV to EBITDA is negative 69.91, which signals severe operational cash burn. The price-to-book is 10.61, meaning it currently trades at more than 10 times its liquidation value. And then there is the EV to sales.
The disconnect here is just stark. As we said, a normal tech EV to sales is 5 to 10 times. Rigetti's EV to sales, it is 754.45. Let that sink in for a second. That means investors are currently willing to pay over $754 for every single dollar of Rigetti's $7.08 million in revenue. It is an absolutely astronomical premium.
Concluding our relative valuation. If we applied a really generous normal tech multiple of, say, 10x to Rigetti sales, the implied intrinsic value per share would be less than $1. Less than $1. That's a tiny fraction of its current $17.50 price. It implies severe overvaluation. The stock is trading entirely on a future narrative, completely untethered from current peer multiples.
Let's pivot to Section 4. Asset-based valuation, unlocking NAV. Since earnings and cash flow models have totally broken down on us, let's dust for fingerprints on the balance sheet to see if the company's raw assets justify that $5.8 billion market cap. We do this by calculating the net asset value, or NAV. This calculation is basically asking a grim but necessary question. If we stopped everything, shut the doors, and liquidated the entire company today, paying off all debts, what is actually left over for the shareholders? It gives us our mathematical floor.
And this brilliantly illustrates how we can extract that floor value directly from the raw metrics. First up, we note the debt-to-equity ratio is exactly 0. They carry absolutely no debt burden. Second, their current ratio is a massive 37.42, meaning they are incredibly liquid right now. Third, because we know the price-to-book ratio is 10.61 and the current stock price is $17.50, we can do some quick reverse math. If we divide that $17.50 price by the 10.61 multiple, we estimate the actual book value, or NAV per share, at roughly $165.
So, based purely on the concrete data provided, the fair market value of the assets minus liabilities yields an intrinsic value of approximately $1.65 per share. This is literally the only positive, mathematically sound number we've been able to generate today, but even still, it is roughly 1/10 of the current trading price.
All right, let's wrap this up. Section 5, synthesizing the final verdict.
Bringing all these threads together reveals just a vast discrepancy. We have run the absolute gauntlet of valuation frameworks today. The discounted cash flow and dividend models yield 0 to negative values, but to be fair, they have low reliability because Rigetti is pre-profit. Relative valuation using standard multiples implies a value well under a single dollar. The asset-based NAV gives us a reliable mathematical floor of about $165. Yet the actual market price out there in the real world sits at $17.50.
So why do these models break? Simply put, because they demand current cash and profit. The strength of our analysis today is that the NAV provides a true concrete baseline. The weakness, of course, is that traditional models are practically useless for a company valued purely as a speculative call option on the future of quantum computing. But purely as a financial analyst looking strictly at the fundamentals and the hard math available to us today, the conclusion is absolutely unavoidable. Rigetti Computing is fundamentally overvalued.
But I do want to leave you with this final provocative thought. Despite every single traditional metric screaming that the stock is wildly overvalued, Rigetti boasts a trailing 12-month total return of 91.47%. They have almost doubled in a year. When investors completely ignore the dismal present fundamentals to aggressively buy into the future, we really have to ask, does the market know something the math doesn't? That right there is the fascinating tension of deep tech investing. Thanks so much for joining me on this explainer, and remember to always keep questioning the data.